Imagine a billion-dollar tech company. They absolutely dominate their sector, they're boasting record-breaking growth, and honestly, they have a backlog of orders that most of their competitors would literally kill for. But you look under the hood and you realize something crazy. They are running on fumes. Welcome to today's Explainer, where we're taking a deep dive into Shoals Technologies Group. Wall Street analysts are calling this stock a highly leveraged coiled spring, and you know what? They might be right. We are going to look at all the massive tension building up inside this company right now and try to figure out exactly which way it's about to snap. Okay, let's dive into this because $1.9 million, that number right there, that is the heart of the current panic around this stock. At the close of Q1 2026, Shoals, which is a company worth over $1.5 billion, remember, reported having just $1.9 million in cash. I mean, to put that into perspective, they were burning through about $49 million a quarter. So mathematically speaking, they weren't just running out of runway, they were quite literally weeks away from hitting a concrete wall. So the million-dollar question, or, well, the billion-dollar question really, is how does a company of this massive size, with incredible, undeniable organic demand, find itself staring down an existential liquidity cliff? How does that happen? To really understand this, we need to treat this explainer like a forensic investigation. We've got to dig in and find out where the money actually went, why the broader market punished the stock so severely, and most importantly, why this absolutely terrifying cash balance isn't necessarily the death knell it appears to be. To untangle all these dense financial weeds, we've got a pretty clear roadmap. First, we'll look at the cash crunch illusion. Then, we'll cover high growth and squeezed margins, followed by the AI power play. After that, we'll get into removing supply overhangs, and finally, valuation and price targets. All right, kicking things off with Section 1, the cash crunch illusion, and a crucial balance sheet maneuver. Now, what's really interesting here is the inverse relationship we're seeing on the balance sheet. Cash completely plummeted down to that $1.9 million level. But right alongside that, their inventory absolutely skyrocketed to nearly $159 million in a single quarter, right? So the cash didn't just vanish into thin air. Management aggressively spent it to stockpile materials. They essentially drained their bank accounts to physically build the products needed for a massive, massive wave of incoming orders. This is a classic working capital squeeze. It's not a broken business model, it's just a temporary timing issue. But as we all know, an explanation doesn't exactly pay the bills, right? Knowing they were dangerously close to running out of cash, management pulled off a really vital maneuver. Instead of panicking and issuing new stock, which obviously dilutes current shareholders and tanks the stock price, they amended their credit agreement to secure $50 million in new revolving loans. It was basically a financial save right at the buzzer. And this brilliant move bought them a crucial 18-month runway to let that massive pile of inventory actually ship to customers and eventually convert back into hard cash. Moving on to Section 2, high growth, squeezed margins. Let's look at that tension between top-line revenue and actual profit. I mean, 74.9%. This is a genuinely staggering figure. In Q1 2026, Shoals' revenue surged by almost 75% year over year, hitting $140.6 million. And what's absolutely key here, what our forensic analysis confirms, is that this was entirely organic growth. They didn't just go out and buy another company to inflate these numbers. No, this is pure underlying market demand for their proprietary electrical systems in both utility-scale solar and battery energy storage. These products are literally flying off the shelves. But here is where we find that tension. Despite those massive sales, their official accounting, their GAAP net income, actually showed a loss of roughly $300,000. So how does that make sense? Well, it's mostly because of one-time legal settlements. They had to absorb these massive temporary expenses for an old wire defect and a lawsuit, the vast majority of which insurance actually covers anyway. So when you strip out those temporary legal nightmares to find their adjusted EBITDA, which, shows us the actual cash-generating power of their day-to-day operations, they were highly profitable, bringing in $21.1 million. All right, let's pivot to Section 3, the AI power play and the world of hyperscale data centers. So Shoals already has a really deep competitive moat built on systemic labor arbitrage and steep switching costs. But the third part of their moat, that is the real game changer here. High voltage, direct current architecture. See, modern AI data centers run these immense server clusters that spike from idle to absolute peak power in literal milliseconds. Think of it like turning on a million vacuum cleaners at the exact same second. Those violent power surges can literally collapse a local utility grid. But Shoals systems are designed to completely isolate those massive AI power transients from the grid. It's a huge advantage. And this brilliantly illustrates how this technology entirely transforms their total addressable market. Shoals is actively pivoting their expertise from traditional solar farms directly into the hyperscale AI space. Winning just 2 to 3 gigawatts of data center backup power translates to a $100 million to $180 million high-margin revenue stream. That is massive. This isn't just some cute side project. They are suddenly positioning themselves as an absolutely critical AI infrastructure play. Okay, Section 4, Removing Supply Overhangs, specifically looking at institutional exits. For years, a massive private equity firm called Oaktree Capital Management held millions of shares from back when they originally took Shoals public. And every single time the stock tried to break out, Oaktree would sell these huge blocks of shares into the market. They were basically acting as this invisible ceiling on the stock price. Well, digging into the SEC filings confirms that as of Q1 2026, Oaktree is fully out, a 100% position change. So that massive structural ceiling that was constantly holding the stock down, it has completely vanished, gone. Now combine that new technical freedom with their project timeline. Remember that bloated $159 million inventory that drained all their cash earlier? Well, that was built specifically to service a record $758 million backlog of legally binding take-or-pay contracts. And if you look at the schedule, from late 2026 into early 2027, $628 million of that backlog is contractually scheduled to ship. So that trapped inventory is going to rapidly unwind, and it's set to trigger a violent, incredibly positive explosion in free cash flow. Let's bring it all together in Section 5, Valuation and Price Targets. It's time to actually price the equity. Let's move to the peer matrix and see how this builds against direct competitors. You've got Array Technologies trading at a 7.6 times multiple, and Nextracker down at 3.3 times. Meanwhile, Shoals is commanding a premium 14.0 times multiple. You might be wondering, why the huge premium? Well, it's because Array is bogged down by really complex debt, and Nextracker's products are highly commoditized. Shoals, on the other hand, possesses a proprietary tech moat that defends that premium price tag, especially as they rapidly expand into the AI sector. To really wrap our heads around the stock price, we like to use reverse DCF logic. So, instead of trying to blindly guess future cash flows, we ask, what growth rate is the current stock price already predicting? Based on an enterprise value of $1.67 billion, the market is currently pricing in a super aggressive 31% annual cash flow growth rate over the next 5 years. Now, for a pure utility solar company, that hurdle rate is absurdly high. But with Shoals securing these high-margin enterprise AI data center contracts, suddenly that 31% expectation is completely justified. Which brings us right to the two potential futures for this coiled spring of a stock. The base case sits at a $13.50 price target. This basically happens if they simply execute their existing utility backlog. The inventory normalizes and their cash balance naturally recovers. Very straightforward. But then you have the bull case, which targets $18 even. This happens if their on.energy partnership scales beyond 2 gigawatts, and the broader institutional market finally realizes that Shoals is no longer just some solar parts supplier. Instead, they reclassify it as a highly profitable, critical power AI infrastructure provider. That tension is palpable, isn't it? It really is like a coiled spring. The private equity sellers are totally gone, the cash crunch is legally shielded for the next 18 months, and hundreds of millions of dollars in guaranteed revenue are literally just sitting there, waiting to ship. So the big question we have to ask ourselves is this. As that working capital aggressively unwinds over the next few quarters, will Shoals just be remembered as a cyclical, tariff-burdened solar supplier? Or are we watching the birth of the premier critical power data center play of the entire decade? Honestly, keep your eyes on this one, folks, because that spring is about to release. Thanks so much for joining me on this explainer, and I'll catch you next time.